So Peter's set the framework as to why we're doing what we're doing, we as in the whole financial markets, and this is not just the banks. Obviously they're impacted here, but your good selves, anybody that trades a financial instrument. And I think I like this phrase because, and I think it can apply to just about anyone in anything, in any area, and it's particularly, I think, important here is that I use this on my kids a lot. They choose to listen or not listen. But the only place success comes before work is in the dictionary. And I think as far as what we're all doing now, and the regulators and the financial industry, etc., is that there is a lot of work to do before anybody can really claim any success in terms of what we're all trying to achieve. So in terms of setting the rules for mandatory clearing, what are the regulators what are they actually looking at here in terms of the setting of these rules, and would define them sort of fairly broadly here amongst those points, and a lot of them are fairly linked. As far as the entities that are going to be caught in clearing is concerned, and certainly as far as what has come out from the regulators in the last few months, is that essentially they're just trying to capture large financial institutions that have significant cross-border activity. So effectively, as Peter said, there's maybe 8 dealers in the Australian market that make up a lot of the derivatives, sort of outstanding derivatives. There's probably more like sort of 12 to 14 that I think that the regulators are trying to capture here in the initial stages. As far as taking that a little bit further as to who else should be captured here, we could use notional principles. I mean, that's used for trade reporting, I know, of a threshold of 50 billion. There's some argument amongst the banking group as to whether that should apply as far as a clearing mandate is concerned, because really you could, and I think we're trying to sort of get to more of, I think, of a risk-based measure of the portfolios or the amount of risk that entities put into the system. So, for example, you could, if a notional threshold was set of, say, 50 billion, you could have an entity that is very much one-directional in terms of that risk that they're putting in and fall under the 50 billion cap and not be captured, as opposed to someone that perhaps has, say, 100 billion of notional, get caught in the mandate, but have, say, a relatively matched book, but realistically is not probably putting as much risk into the system as that entity that has one-way risk. So then we sort of look at other things like systemically important, which of course, as I say, Peter has already mentioned as well too. And again, that ties back into the amount of risk that an entity perhaps has put into the system. There's other forms that perhaps could be used that, say, for example, the CFTC is used, which is swap dealer or swap participants, end users. There's a lot of sort of discussion as to exactly what is an end user, and essentially really, I suppose, where it comes down to is those participants that actually use derivatives for hedging purposes, and that's probably the neatest way to define an end user as far as this is concerned here. As far as setting the rules for central counterparties concerned, we look for those central counterparties to be domestically incorporated and operate under the Australian jurisdiction with oversight by Australian regulators. However, I think it's fair to say that all regulators across the G20 really just want to adopt an approach that is consistent and equivalent across all overseas regulatory authorities as far as practically possible. Comes back to this substituted compliance and equivalency that you'll hear a lot more about. And what we're really trying to avoid here is any regulatory duplication or legal uncertainty or even arbitrage across different jurisdictions. The regulators are very cognizant of that. They're taking their time to ensure that the rules that are being set around for CCPs and around mandatory clearing, and indeed a lot of these regulations, are consistent internationally. A lot more work to do though before we actually get there. The other point is that as far as, whilst, as we said, there's two licensed operators to clear here at the moment in Australia, likely perhaps only remain as two, but we need to ensure that there is the infrastructure in place for everybody to be able to clear on an even footing. Trade reporting. So who reports? Well, across the banking community, it's the simplest way to put it is the person with the highest obligation. So obviously that ends up being with the bank themselves. Now, as we've said in Australia, we have a two-sided reporting that will be implemented. However, one-sided reporting is fine if you're a small Australian financial service licence holder who does not hold an end user exemption. Now, and if we come back to sort of this end user exemption, there is some tightening of that regulation such that, and this comes back to perhaps your question that you made here, is that if the obligation will only be imposed on AFSL holders with respect to the derivatives that they are licensed under that AFSL, under that licence, so that if you trade something that's not a derivative, you don't hold that licence for, then you're not obligated to report. That doesn't mean that the bank or the person you trade to won't report from his perspective, but you may not be obligated to report. I think the important thing here as well too, as we touched on, is that there is an extension of this phase 3 reporting, because there is a lot of discussion as to the whole end user exemption. Obviously, and as far as a lot of the phase 3 entities are concerned, looking for permanent exemption to trade reporting, and that is still to be worked out by the regulators. ASIC are very cognisant of that, so you wouldn't expect that the requirement for phase 3 reporting to come in its initial stages until at least April of next year for 3A, let's call it, and for 3B and another 6 months after that into October. So there's still, a lot to be determined, as far as those exemptions are concerned. Some of the complications. Privacy conflicts. Now, the letters of consent. This is a very tricky one for banks, and what we actually do is we send out letters to our clients and counterparties who we trade with to say that we need to report your trade, and we need your consent for us to be able to report your trade to the regulators. You either reply back and say, yes, that's fine. You don't reply back. In Australia, we can use something called a consent by performance. So, for example, we send you the letter, you don't reply, you trade with the bank again, that to us is deemed as consent by performance, and so we will continue to report that trade. Interesting and questions that have come up in past sessions is, has this been tested legally? No. Do we want to see that tested legally? Well, perhaps let's not go there as far as that's concerned. But I think the simplest thing here as far as the privacy issue is concerned and letters of consent is we would certainly hope that our counterparties would reply back with either consent, or if you chose not to consent for us to report your trades, well, unfortunately that means that that bank cannot trade with you any longer and you have to go and look elsewhere. Delegated reporting. This is another tricky one where, and it's all a bit of a mess, and there's a lot of it's still a lot to be worked through here, because there are a number of jurisdictions, say for example in Europe, where we, same as any other perhaps Australian bank, have no reporting obligations, but clients have asked us to do this, to actually report for them, or delegated it for us to do that, and so we do that. But however, it's quite a complex thing to do. It's very costly, time-consuming, etc. There is no fee being charged by anybody to actually do delegated reporting, but we just wonder whether that may be the case. At the moment, it's fairly light touch, say, for a bank like ourselves and perhaps the other Australian banks. But the whole issue at the moment as well, too, is that really there's no agreed framework and infrastructure in place for us to report back to the client what's been sent to the repository. There's a lot of onboarding issues, there's legal documentations, etc., that need to be exchanged between banks and clients. And really, I suppose, as far as the clients are concerned, you're left sort of really a little bit unsure and with fairly short time frames to actually onboard as far as this is concerned. So, so there's still a lot, as far as delegated reporting is concerned, there's still a lot to actually go through there before we've got something efficient that both bank and client are happy with. So to clear, or not to clear, some of the benefits of clearing. And, whoops, as Peter's alluded to, and we will just cover off these points briefly, is that obviously under Basel III, really, some of the benefits of clearing are seen here as stability in markets. There's as far as cleared transactions is concerned, there is a lot more liquidity in cleared transactions in OTC derivatives. There is a somewhat more tighter pricing of cleared transactions versus non-cleared. That really all comes down to the fact that in time ahead is that there'll be much higher capital charges for non-cleared transactions versus cleared under Basel III, and we'll go through that in a moment. And there are potentially lower initial margins that you would pay on cleared versus non-cleared transactions, and that's still subject to more work by the BCBS and IOSCO. And again, I'll demonstrate that fairly shortly. Costs of clearing, there's the nominal costs as well as a lot of other sort of processing or sort of man hours, etc., to do this. Initial margin, variation margin that needs to be posted. As far as initial margin is concerned, you can do that in cash or securities, but at the central counterparty, they will take a spread against the cash rate for the posting that initial margin. The variation margin is really just similar to you get paid or receive the cash rate, and that's just an exchange of those counterparties that are in the money on a swap versus those that are out of the money. Clearing fees and maintenance fees at clearing houses, they start to add up as if you have significant volumes in clearing houses, as well as there's ongoing initial infrastructure cost processing changes. The contractual arrangements with CCPs or indeed with clearing members, if you choose to clear third party, can be quite exhaustive. It does take a long time to set up these arrangements. And the other point as well too is obviously there are potentially a lot lower returns from the collateral that you're actually posting to a CCP for extended periods of time that you can obviously otherwise use more effectively elsewhere. So under the BCBS IOSCO rules on margin requirements, how are you going to be affected? So the margin requirements, as we've seen, are going to be phased in from December 2015 with full compliance by 2019. Now, the clearing requirements will not apply to a swap if one of the counterparties is a non-financial entity who uses swaps to hedge or mitigate risk. And that probably breathes a sigh of relief for a lot of you here. However, traditional over-the-counter trades will get caught by Basel III rules on margin requirements for non-centrally cleared trades. So that starts to affect the price in terms of what you're actually trading at. So the BCBI IOSCO rules will apply to anyone who is entering into a bilateral trade and will be subject to initial and variation margin rules. By anyone, I mean the bank that, say, for example, is doing that trade and potentially the counterparty. So attention is focused on all derivatives that are not cleared by a CCP. Exclusions are FX forward contracts and cross-currency swaps. There's a little bit of a misnomer about cross-currency swaps as to whether they're exempt or not, and they largely are. It's just the principles that are exempt on the cross-currency swaps. However, the interim payments within that swap will be still subject to margining, although obviously you can imagine it would be a lot less than it would be if principles were included. Now, the entities that will be covered will be all financial firms and systemically important non-financial firms. Now, this is actually, the precise definition of this is yet to be determined by each of the national regulators, but really you've got central banks, sovereigns, non-systemically important, non-financial firms that won't be covered. And of course, then you won't be subject to the rules if you fall below the threshold that Peter mentioned before of around 8 billion of notional outstanding, 8 billion euro notional outstanding swaps. So it probably, to maybe a large number of you, it means that you perhaps would not necessarily be affected by, if you're non-systemically important, fall under that threshold, maybe the impact for you is a lot less as far as these margin requirements are concerned. But, as I say, it doesn't change the fact that the price you trade at in the market will change because your counterparty is going to be subject to this. So what does that mean in terms of what is the actual cost as far as this is concerned? Now, if we look at very high level here at the initial margin that would be posted on bilateral swaps, this is as proposed by the BCBS. They're saying that, and this is for standard vanilla interest rate swaps. So the margins are there. So say, for example, if we look at a 2-year duration swap, it's around 2%. If it's centrally cleared, it's around about 1.8%. But the bilateral swap doesn't recognise netting. So in actual fact, the bilateral swap will end up being just slightly more expensive than that 2% notional. In the BCBS table, when they look at a lot of these asset types, there is also a category of equities, commodities, and other, which says that, and other being, we could talk about sort of a lot of very structured type trades, inflation swaps, linkers, those sorts of things, those sorts of derivatives. They are subject to an IM of notional exposure of 15%, which is obviously a very big number. So the more complex the transaction that you actually do, the more highly likely that the initial margin that you would have to post on that trade is a lot higher than, say, a standardised interest rate swap such as we see here. So, and just putting this back into context, and so say, for example, if we try and put that in basis points, it looks fairly ugly on a slide. But trying to put that back into basis points, what does that mean in terms of the cost in basis points? Well, depending on the duration, you're talking anywhere between probably around about 5 to 10 basis points in terms of the cost, this extra cost that's going to be imposed on banks. So if we look at it in terms of risk-weighted assets, how banks look at these, and what does this cost mean as far as RWA is concerned and capital costs? So as a clearing member of CCP, you get a risk weight of 2% that is applied. As an indirect member or as a client clearing member of a CCP, the risk weight is 4%, provided your initial margin is protected from the default of the clearing member and the clearing member's clients, and there is a highly likely porting of trades. Porting of trades means that you can move from one clearing member that you have to another clearing member, That means you need to have two. Well, obviously that potentially doubles the cost, but it does give, for banks, it does give us some relief under RWA. For clients, to actually have two clearing members would be incredibly expensive, and I think you'd have to have significant derivatives portfolios to warrant having more than one clearing member. As an indirect member, if the above requirements are not met, then it's approximately a 20% RWA is applied, which is the same as a bilateral trade. The calculation, that's really on a portfolio basis. It could be higher or lower than that depending on the loss given default ratios that apply to different counterparties, but that's just approximately where that's at. So therefore, in RWA terms, it means that the cost for a bank to trade bilaterally is roughly a factor of 10 times more expensive than it is to trade on a cleared basis. So that means that, and certainly one of my roles is to compress our bilateral trades out of our derivatives portfolio as much as possible before December 2015, when these higher capital charges are going to come in for bilateral versus cleared trades. So the one thing for certain though is that under the new regulations, the cost for doing transactions on a cleared or a bilateral basis is really only unfortunately going one way. So what can you all do about it? What can you start thinking about and talking to your banks about? I'm sure you've all sort of been subject to CVA, or credit valuation adjustment, debt valuation adjustment it is sometimes known, versus a credit supporting annex, which a lot of the banks and counterparties have between themselves. So as far as Basel III concerned, it is going to increase the minimum level of capital a bank has to hold against the risk of loss from its counterparties on derivatives exposures. So what's important here, what are the impacts for you as corporates? Well, the credit quality is all important here, which will determine the CVA, including the probability of default. The actual transaction itself is a factor where EPE, expected positive exposure and expected negative exposure are the key. Longer dated derivatives are particularly important, as well as more complex style derivative transactions where the charges would be quite higher, as I indicated before. However, you can use collateral to offset exposures through the signing of a CSA with your counterparty. The hedge considerations for corporates, what do you actually do? Do you continue to deal in the same way as you've been dealing and accept any increase in pricing, as we've illustrated here, or perhaps tweak your hedges slightly to make them less capital intensive? Or do you collateralise your deals with bank counterparties through a CSA? Perhaps consider clearing. Or the final one, which obviously I don't think anyone really would be too thrilled about, or is an option, is to minimise or stop hedging altogether. Not really a desirable outcome, I don't think. So if we look at the comparison between a credit supporting annex and CVA, credit valuation adjustment, the CVA is priced up front and therefore is a known cost to the corporate and the bank at the time, and the risks are left with the bank as to what exactly happens with that, with the credit quality of that counterparty during the life of the trade. As opposed to a CSA, a credit supporting annex, where the collateral funding can change over time in both positive or negative sense, depending on whether your swap goes in or out of the money. So the risks remain with the corporate. So if a CFO believes that the company can raise collateral more readily and cheaper over time than what the bank is charging on a CVA charge, well then perhaps a CSA makes sense. Banks have a return on capital that really have to be met, so that for uncollateralised trades where there is a higher capital treatment, then the bank will charge a higher CVA charge, just the same as that the bank will look to pass on the full cost of this expected exposure that we have. CVA is calculated using CDS spreads for the long term. However, that can change over time, and there is, as far as CDS spreads is concerned, they do trade at a significant risk premium really by the nature of what the protection that they actually give. The other important point here is that, the biggest point here is that collateral under a CSA, you have to fund that short term, so you really have to have liquidity at your disposal to move collateral on a daily basis. So there are short-term funding and operational considerations that need to be met here. So just to sort of start wrapping this up, there's really is a high correlation like never before between risk and the cost for the buy side than we've seen in the past. And so should you really be concerned enough about CVA charges, for example, to start collateralising or clearing? As I said, you need to mobilise liquidity quite quickly in order to be able to do that. In terms of clearing, do you choose one clearing broker or one CCP? Does that come with a bit of a concentration of risk within your activity? Other cheaper solutions, perhaps use of swap futures, but really that doesn't give you the most effective hedge that you want. Really, I think as far as corporate end users and buy side is concerned, you really do try to seek, a transaction which hedges the needs that you actually have in the most efficient way rather than leaving some risk on the balance sheet. So, and so really, as far as, say, if we look at, say, what the market would look like in the future, does that mean that, say, banks are really going to start offering more standardised products as the G20 has and the Basel Committee has really proposed, so that banks decide not to offer as capital intensive, the capital intensive products that are really quite costly to actually trade in. However, if the client is still happy to pay that, well then, of course, we will still do that. So even if the banks were prepared to offer those products, the price will widen to a point that perhaps might drive people more towards the standardised, dealing on standardised products. And of course, markets will try and evolve and respond by introducing perhaps some new innovative products which have a less capital intensive of a less capital intensive nature. Finally, really, are we consolidating risks within clearinghouses rather than diversifying across several parties as we've done before? I think perhaps the answer is a combination still of the two, between a diversifying of, certainly as far as the client side is concerned, between perhaps clearinghouses and spreading across several parties bilaterally. From the bank's point of view, it's fairly clear. The risks are going to be focused in clearinghouses, but do those clearinghouses really end up capturing all kinds of risks and interconnections that really previously were dispersed amongst banks? And this is perhaps one of the major unintended consequences of moving to central clearing. And in time, will there be a new breed of risk experts that start to whittle away at these risk management standards as it was done in the past? But certainly that is not what the regulators will want to happen or will look to happen. And generally speaking, I think it's fair to say that people in finance really look to try and repair, perhaps to some extent ignore but not forget the failures of the past, and really just more towards working to a brighter future. From a bank point of view, and then ultimately from a client point of view, I mean, the answer to that, of course, is yes. From a clearing point of view, whilst the banks, the Australian banks certainly, for example, are not in a position just yet to offer clearing services to the Australian market, and part of that reason is because there is still no mandate yet, apart from the bank market, to actually mandatorily clear swaps. However, each of the banks is, I can say, is looking at the possibility of offering clearing services to clients. There is no golden egg to offering that service to particular clients, but where the greater assistance does come from is in the collateral management of those exposures. So, and that's to the very point of your question, is that whilst clearing services may well be offered by one or all of the Australian banks at some point in time, the important management of that clearing process actually becomes with the collateral, and that collateral is in the form of cash and securities, and particularly as far as securities are concerned, if we're talking about fund managers here as well too. Trade reporting, we'd like to think that one-sided reporting is going to work, but I think ultimately, it's going to end up being two-sided reporting, and I think it ultimately does mean that the banks will have to offer a reporting service for clients, or a delegated reporting for clients. What that does mean, though, that if banks do offer those services, it doesn't absolve the client or the end user from actually ensuring that reporting of that transaction is accurate. So, in terms of, mentioned before about, is the whole one-sided reporting, can that stand up in a court? As far as the obligation for clients to ensure that their reporting is accurate, if that is delegated, if they ask a bank to do it, that they can't leave the bank to ensure that to say that, oh, well, if the bank reported that incorrectly, that's not my problem. Well, it actually does become your problem. So in that sense is that, yes, ultimately I think banks will probably have to offer the delegated reporting, but it will be two-sided, and both sides will have an obligation to ensure that that reporting is accurate.